that this is the first class for you. The corporate finance course. This is the first. Yesterday you didn't have classes, right? So welcome. Welcome to the financial analysis course. And welcome to the corporate finance master degree. This is the team. So Saverio Bozzolan. I'm older than them, so I'm the professor. And Wenda Esposito and Luigi Marini. They will support me, but especially will support you during the next 12 weeks. Okay? First of all, this is an introductory class in terms that we have some ideas that I want to share with you, but most of the class is regarding the organization of the work for the next 12 weeks. You see in the MyLuis platform, and there is the website of the course. And I have uploaded almost all the material for all the course. Okay? There are several sections in the website. So the general information, communication, video fields, course material, from theory to practice classes, additional readings, whiteboard because during some classes we will teach using the whiteboard. So at the end of the class we record the whiteboard and put the whiteboard on the platform. The case study, project work, and the space to upload the project work. Almost all the materials is already there. What it is not is the case study, because we are finishing the two case studies that we work on during the next classes, and we will upload one of these during this week. So I will focus on the general information. So this is our main reference, your main reference. You have the description of the course, some indications, information regarding the calendar, the teaching methods, the materials, the reference book, etc., etc., the readings that I would suggest, the rule for the attendance. What we applied what is called a 3P scheme: presence, on time, and present for every section. Please be on time. If you need to leave earlier, please sit close to the door to not disturb colleagues. Prepared. If we ask to make some pre-work, please do it. And expect cold calling. So I usually ask, oh, please, what do you think about this? And just to make the class more interactive. And participating. So we expect questions. We expect that you share with us and with your colleagues if you have doubts. If you not understand something, please raise your hand and ask. Okay, we are happy to answer, because we think that to have an active participation for you is one of the most important things. The assessment, I believe that you have received several information regarding the assessment rules. So the 3 categories of students, etc., etc. As a recast, we have the final written exam that counts 20 points, and the continuous assessment that for us is a project work that is 1/3, so 10 points. I will talk about the project work in a couple of minutes, just to explain the logic. And And then there is the retake section and the assessment on compliant and exempted students, etc., etc. So all the information, I think that all the information that you need is here. If you don't find the information here and you have doubts, please write to them. Okay, to Wenda and to Luigi. Okay, or ask me during classes at the beginning or the end of the course if you have doubts. And the answer is not here. So your main reference is the syllabus. Regarding the continuous assessment. The continuous assessment is a project work. So we will form the groups in 10 days. Groups are formed by 5 students, randomly chosen. And we assign to each group a company, and you have to make a financial analysis of this company. Okay? So we show you how to download the data from a database. That is the Icon Refinitiv. We will show you how to reformulate using Excel the financial statements, so the balance sheet, the income statement, and the cash flow statement. Calculate the financial ratios, and at the end you have to prepare a report, or better, a PowerPoint presentation, and that during the last week of the course you are asked to present, and it counts 1/3 of the data. Okay. I don't want to enter too much in detail regarding the project work now, because we build step by step the logic and the different techniques for the project work during the next few weeks. Okay? So the first step is next week, when we have a discussion of the reformulation of the balance sheet for one of the 2 case studies. Okay, there are 2 intermediate dates in which you will be asked to present the first and the second part of your project work. So in the first date, it is the October 14th, you are asked to present the reformulation of the balance sheet and the income statement. It means that we will ask you to come out and present your intermediate work. October 29th, the interpretation of the cash flow statement, and on November 11th, there is the Q&A regarding the Excel. So all the questions regarding the technical reformulation of the company. After that date, we do not answer to questions regarding the Excel file. We can answer questions regarding the project work, but not technically related to the Excel file. Okay? This is the calendar. For the calendar, you have here the detailed schedule. So this file, in this file, you find the time, the date of the class, the time of the class, where you find the information, so the slides, and from theory to practice number 1, that is a subset of exercises, etc. And this is the content of the class. Okay? And the reference to the book. Okay? And you have this day by day. It is clear that it might change during the course, because we could be longer in this class, so take as an indication, and we try to follow as much as possible this schedule. Okay? And this is the second file that you have here. Well, this is the class hours. So this is, so you see here that this is what I have downloaded on the August 3rd. And the room was wrong. Okay, so it is a reference, but not not take this as the truth, because they might be changed the room, etc. And please be aware that for some weeks we have a small change in the date of the class or in the hour of the class. Okay, but this is in the detail scale. This is indicated in the detail scale. So, for example, November 3rd, we have class between 12 and 2 p.m. And mid of this is the classes for the discussion of the project work. But please check the detailed schedule or check your app. There are other files here. So there is because there is a group and we assign a grade for the entire group, we have introduced what we call peer assessment, and you probably know the logic. So each group component evaluates the participation of the other group components in the work. Okay? So, for example, if the Luigi, Wenda, and myself are the components of a group, I have to evaluate the participation of Luigi and Wenda. If the grade of the group is 10, but they do not participate so much, I grade the level of their participation, and the effect is that their grade might be lower than 10. It is clear that it is an average, and you see in the module for peer assessment the logic that we have adopted, and we have adopted since 5-6 years ago. So it is quite well tested. Okay? So the point is that we would like to do not have free riding behaviors, and we don't want to have people that do not collaborate with your colleagues. It is a team, and you have to work with a team. Okay? So it is only a way to reduce the probability or increase the risk that you face when if you don't work properly. Okay. In the video peers, there are 4 short videos regarding the content and structure of financial statements, the presentation of the documents of an annual report using the AMER case, so what is in the balance sheet, what is in the income statement, what is in the cash flow statement, the objective of financial statement analysis, and the process of financial analysis. They are very short, and I invite you to look at these videos before next week. This is the course material. The slide that we will use during our classes. This is the exercise book that is mainly based on previous exams. And most of them are, there is also the solution. If you find some errors / mistakes, please send an email to Wenda, because we have prepared a new version of the exercise book this year, and it might be that there are some mistakes. We apologize for this now, but please signal this so we can correct and we can inform if there are mistakes, and we can also correct the exercise. And the third, there are the whiteboard that eventually I will put on there. From theory to practice classes, there is the material of exercises that we will do during our classes. In this, okay. In this there is the test of the exercise and also the solution. I have to even hide the solution because otherwise they know the solution before I have to remember this. Please do not download the solution right now. But because there are exercises that we do during our classes, I prefer to do together and then show the solution. Okay? And please do not download the solution. And that's it. Okay? You have questions? From our side, we will make the groups in a week, and we will upload the case study material. There are two case studies, Lube and Fila. We will upload the Fila case during this week, because if you see the detailed program, we will discuss the reformulation of the income statement of the balance sheet next Tuesday. Okay. Are all of you enrolled in the system? No, in this My Lewis system.
No, it doesn't work.
So if you don't have the access, please send me an email, because what is your name, please?
Filippo Bagno.
Filippo. No, you are not here. Ah, here. You are already. Okay. So if you are not in the list, so if it doesn't work, I cannot solve the issue. You have to write to IDT. Any other that is not in the system? Your name, please.
August. August, like the month.
Ah, okay. Is this the first name or the family name?
That's the first name.
Okay, you are not.
No.
And your
Christopher.
Christopher. Okay, you are not. So please send me an email so I can enroll into the system, and you can access the platform. And this is also important for the attendance. Okay? Any other? Okay, so Filippo send an email to the IT, and both of you send an email to me so I can enroll. Okay? Perfect. So that's all for now. It means that we have not ended the classes, but we start class.
Cambiare telefono perché sono sarà buggato dopo che ho fatto l'aggiornamento, quindi vuol dire che la versione Android non è, c'è l'obsolescenza programmata.
Ok. So,
Certo, potevano includere di più.
there is another file that I haven't opened in the platform. This is our office hours. So you have information regarding our email address and our office hours. Okay? And I suggest you to use office hours, and if you have doubts, please send us an email because it is important. We have 12 weeks. We have a lot of work to do, and it is better if you have doubt, please send us an email to clarify the doubt as soon as possible. Okay? So the focus of the course is financial statement analysis. It means that we start from the annual report and we try to extract information from an annual report to obtain an evaluation of a company. So this is the first step of the way through which we evaluate the value of the company, the enterprise value of a company, and the focus of the course is the analysis of the financial statements. Okay? So at the end of the course, looking at the financial statements, you will be able to reformulate the financial statements to obtain some key performance indicators. Probably you already know some of them. So the EBITDA, the free cash flow from operations, net working capital, probably some concept you already know. And, but most of all, to write a report to evaluate if the company is overvalued, is undervalued, if the company is listed, or to assess the future profitability of a company. So this is our main aim. And we perform this doing a fundamental analysis. What is a fundamental analysis? The fundamental analysis is a way to assess the ability of a company to make profit, to generate profit, to assess the financial solidity of a company, not only in a static way, but also in a forward-looking perspective. Because the aim is to evaluate if a listed company is valued with some biases or not. The point is that we are far away from the assumption that we make in finance regarding the market efficiency. Because market efficiency assumes that the prices of a share represent the value of the share. But prices and values might be very different. Because prices is what you pay for, and value is what you get. And there are a lot of examples in economic history in which prices are significantly different from values. Do you have studied some, did you study some of these events where prices were different from values?
For example, the dot-com bubble in 2002.
The dot-com bubble,
Lehman Brothers bubble.
Lehman Brothers, but in the history, yes?
Tulip bubble.
The tulip bubble in the in the 14th century, and if you are not aware of the tulip bubble, this is the first bubble in the history. And if you go to YouTube and write tulip bubble, there are some videos that might explain the tulips, the dynamic of the price of the tulips in the Netherlands. So the point is that our starting point is that the market price do not reflect the firm value. And the firm value is represented by the intrinsic value. What we obtain using a discounted cash flow analysis, or the economic value of a company. I'm saying some concept that probably you have already studied. But our point is, we focus on the financial analysis, which is a significant step to assess the intrinsic value of a company. So prices, values. In this course, we do not look at prices. Okay? We focus on the value of the company to assess if the value of the company represents the price, or the price represents the value of the company. It means that the company can be overvalued or undervalued. And we want to study the determinants of the value. Okay? And we focus on the annual report. We focus on the financial statements as the first step. And this is an example. This is an example of the difference between prices and values. And it might be used to explain the lack of rationality in a financial market. So, at the beginning of the day, there is one person on the phone saying, I've got a stock here that could really excel. So excel, so they started to sell, and all the market is selling. At the end, one person say, this is madness, I can't take any more, goodbye. Goodbye, buy, and the market starts to buy. And this is the base of the bubbles. The company is the same, the results are the same, but the dynamic of the market is completely different. And there are a lot of examples. Think, for example, at Tesla in the last 3 months. What happened to Tesla during the last 3 months? Yeah?
It dropped down
Why?
because of the Elon Musk and Trump fight.
Because, and is this something related to the company? Absolutely not.
Yeah, actually yes.
Why? Yes.
Because Trump threatened to cut off the finance from the government to Tesla.
Okay. But partially yes, but most of the point was based on the fact that Elon Musk was very close to to the president of the US. And this is not well perceived by the consumers. And the demand for the cars, the Tesla decreased. So this is the first. Then, because they start to fight, there was another step. But at the end, there are something that is not related to the company that has an effect on the price, not on the value. Okay? So, and there are several examples. The dot-com bubble, prices, not value. So the first question was, but if this is the situation, that prices are not related to the financial results, are financial statements important or not? And there are several items here that show that financial statements seem to lose the relevance. Until mid-90s, if you put on a graph the earnings per share and the share price, you can draw a line, and if you make a regression, you have an R square of between 90 and 95%. It means that if you have the APS, it is very easy to forecast the share price. Because there is this regression line with a very, very high R square. Okay? But with the dot-com bubble, the profit were considered unimportant. So we had Amazon, that was a loss-making company for years, with a very high evaluation regarding the share price, the shares. We had Tesla until 10 years ago. Tesla was a very loss-making company with a market capitalization similar to the General Motors. So profits were considered as unimportant. The increasing role of intangible asset or intellectual capital, and as you know, intangible asset and intellectual capital sometimes, most of the times, are not recognized in the balance sheet. They are not represented in the balance sheet. And an increasing importance of the non-financial performance measures. So we are looking at other KPIs different from the financial performance. The focus on sales instead of profitability. I don't care if the company is making losses, but the value of the company is the ability to increase the customer base, because in 3-4 years, this amount of customers might help to have profit. An increasing value of what we call price over earnings. So we had companies with a price over earnings ratio more higher than 100. So it means that the share price is 100 times higher than the earnings of the year. So it means that you need 1 century of earnings to have the share price. And it is completely unrational. So we had companies with a price over earnings more than 90 and without any justification. Is it clear that we are in this situation? The intrinsic value wants to explain this price over earnings. Because if the price over earnings is very high, it means that this ratio is high because we use the earnings of this year. But we do expect that the earnings will increase significantly in the next 4 or 5 years to justify this price over earnings, very high price over earnings. And the fundamental analysis helps to explain this. There are 2 papers that discussed the importance of the financial statements. If we are here after 20 years and there is a financial statement analysis course, it means that we have recognized the importance of the financial statements. Financial statements are still important even if we have observed years different phenomena in the market. And the financial statements are the starting point to determine, to estimate the intrinsic value of a company. So the fundamental analysis is the based on the discounted cash flow techniques, the economic evaluation techniques, etc., etc. But there are other approaches in the market that we can use to evaluate the intrinsic value of the company. They are called simple approaches, and there are what we call asset-based valuation, in Italian metodi patrimoniali, and multiple analysis. These are defined as simple approaches because they analyze this problem without considering the performance of the company. They do not require a significant amount of information. So they are very easy to use. But there is a trade-off. They are very simple, very easy to use. They use a limited number of information. But on the other side, there is the risk of ignoring details that might have an effect on the data. The fundamental analysis is complicated, goes in detail looking at the company, and it is costly. Costly in terms of the effort that you have to put on it, and also in terms of the time that you spend to make this analysis. Simple approach, very quickly. The asset-based valuation, the intrinsic value of the company is the sum of the asset value of the value of the asset. And the value of the asset is not the historical value of the asset, is the actual value of the asset. First of all, we start from the financial statements to identify the asset, but there are one risk, and the risk is that in the financial statements there are not all the assets that the company is using. Because an asset can be completely amortized. We are Gucci, and one of our assets is the building in Via Condotti. And this building is completely amortized. So the value of the building in the balance sheet is 0. But this building has a value. 40 million, 50 million, 60 million, I don't know. And we could have assets that are not in the financial statements. The second issue is that we could have assets, so resources that we are using to generate revenues that are not in the financial statements. They are not represented in the financial statements. The ability of a R&D group in a company. So we have a very, very strong R&D department. And if we are a pharmaceutical company, having a very, very strong R&D department creates value. Because through this, we have patent, we can have new drugs, etc., etc. And is this something that is represented in the financial statements? No, it isn't. Other examples of intangible assets that are not in the financial statements? Do you have some examples? Yes?
I mean, for example, intangibles that the company developed itself.
Okay.
Because you can only record it in the assets that you developed.
A very good point. We call this internally generated. So if, and one example of this, your name please? Ola? Your, an example of this internally generated asset?
For example, the human capital.
Yes, but it is something that you cannot sell.
Okay.
Something that you can sell.
Patent. For example, like if you buy the patent.
Patent? But a patent, you can capitalize the cost of the patent.
Trademark.
Trademark?
The know-how maybe of how to produce product.
The knowledge how to produce product? Yes.
How to optimize the production of product.
How to optimize the production?
Optimize.
Automatize,
Yeah.
etc. Optimize, etc. Okay. But, for example, the typical example is the brand, the trademark, the brand. Okay. So the brand is something that is not simply related to an investment, like a patent. Because a patent, I can capitalize the cost to obtain the patent. But the brand is something that is not related to the investment that you have made to the brand. Because the brand represents your customer base, your the loyalty of the customers, etc., etc., etc. and it is something that is not related to the investments that the company has made. So the brand is a typical example that is an intangible asset that is not represented in financial statements. But if you are, can we say a sport team, for example, one of the most important assets of a sport team is the brand. Because the brand represents the loyalty of the fans, right? A luxury company. She has a lot of Gucci bags, and she spends a lot of money for the Gucci bags, but she doesn't know how much is the cost to produce a Gucci bag. That is 45 times lower than the price of the Gucci bag. Okay? But she believes that the quality of the Gucci bag is very, very high, is higher than Michael Kors. I'm not an expert, but I'm not sure.
This is the reason why I'm still following the course.
So do not buy many. No, I don't want to. No, please do not ask. I go out from this class saying, no, I don't want to buy the Gucci bag, because otherwise Gucci bag sweet me and say, okay. So this is an example. This is an example. The brand creates value, and in some industries, the value of a company is not represented in the financial statements because it is intangible. You raised your hand?
Yeah, I have a question regarding this. Isn't that called goodwill?
A good point. The goodwill is what is that? There is the internally generated asset. Okay. A way to make these available, make these assets in the financial statements, is to sell the asset. Okay, so I have the value of the asset, and this is the accounting value of the asset. So the brand is 0. But if I buy a luxury company and the value of the brand is 0, I find that I pay 1 million euro, and the total asset, the accounting value of the asset is 10, is 100. It means that I paid 900 more than the accounting value. Okay? When I buy the company, I have a cash out. So you remember the bookkeeping? On the right, I have a cash out of 1 million. And on the left, I have asset 100. I have to recognize this 900 of asset. Okay? Because you know that we have to balance the credit and the debit side. Okay? Are you lost? Are you following me? Okay. And this 900. Oh, I have bought the brand, and we evaluated the brand. And the brand is 500. 500,000. So it means that we have 100,000 of already recognized asset. We have 500,000 of newly recognized asset, specific intangibles, and now we have in our balance sheet 600,000 assets. But we still miss 400,000 assets, and we have paid these 400,000 assets. And what type of assets have we paid? the ability to make a efficient production. We have paid, for example, for the location of the stores of the company. We have paid for synergies that we think that we are able to to reach with the combination of the two companies. But this is not assets per se, because we cannot sell separately. Okay? Because we cannot identify this as an asset, this difference is the goodwill. So the goodwill emerges when you buy another company. What you have paid is higher than the value of the asset, the accounting value of the asset, plus the new asset that you recognized after the business combination. So it is what you have paid that is not explainable with a specific asset. Okay. No, the goodwill is the difference. So it is the difference from what we have paid, yes, minus the liability, yes. I have assumed that you have bought only assets. Okay. So I have assumed that the liability is zero, etc., but you are right. Because we have both assets and liabilities, and so we start from this difference, and yes, I forgot the liability, but I would explain only the asset side. Okay? So the goodwill is the difference between what you have paid and what you have recorded in the financial statements. And the point is that we have paid this goodwill because we expect that we have a return in the future. So the first point is that we haven't identified all the assets. And the second is that we have to identify the market value of all assets, not the accounting value, but the market value. What is the... There are several problems in this, using this approach. First of all, for some assets, it is very difficult to have an evaluation of the value. So it is quite difficult to have an analysis of the market value of the asset. So if in our company, if we have 3 Van Gogh paintings and we sell the asset, it is difficult to evaluate the characteristic, the value of the asset. If you want to buy the Louvre, and there is the Gioconda inside, there is only one Gioconda, and what is the market value? There are some assets that are not traded often, and it is very difficult to find the fair value of this asset. Because the market for this asset is not perfect, and it depends on the dynamic of the offer and the demand for. The market value of the asset is different of the value of the asset inside the business. So the building of Gucci in Via Condotti, if we sell the building alone, the value, the price of the building is different from the value that the building has when we use the building in our business combination. Because the there is a very rich Arab sultan that want to buy the building, and he pays 50 million. But if I am a luxury company, the value of the building is not the value of the real estate, but it's the value that the building guarantees to us through the business. It might be higher or lower. Because having this building, I have revenues, an increase of revenues of 40 million per year. And so I use this value to calculate the value of the building inside the business combination. So selling the building alone is different from the sale of the building inside the business combination. And there are several problems, and this is a simple approach with a lot of problems. So this simple approach is useful and applied for in some industries. Real estate. Because why? Because there is an active market, so there is real estate here. Why? Because there is an active market, so it is easy to estimate the value of an asset, and the asset might be sold in isolation. So it is not they are not used in a combination. We can sell this building, this building, this building, and if we sell this building, it does not affect on our business activity. If we sell the Palazzo in Via Condotti, this selling might have an effect on our business condition, on our business, because we have to shut down a store. So real estate company, oil and mineral companies, timber companies, these companies, for these companies, using the asset-based valuation is probably the best approach. But for manufacturing companies, service companies, the asset-based valuation is not very useful. Or better, is not simple as it should be. The other approach is the multiple analysis. The idea of the multiple analysis is that we try to create a link between accounting numbers and market values. And this link is called a multiple. So we make a relationship between the enterprise value or the equity value, usually the enterprise value, and some accounting numbers. Sales, earnings, book value of the asset. And we base our analysis on this logic, and the two most used ratios are the price over earnings ratio, so share price over earnings, and price to book ratio, share price over total asset. What is the way through which we calculate these ratios, and we apply the multiple analysis? First of all, we have to identify some comparable companies. So companies that are similar to the company that we want to evaluate. Usually there are companies in the same industry, and when we refer to industries, means in the luxury market. So for example, for Gucci, we consider not only direct competitors of Gucci, but companies in the luxury sector. Okay? So for example, Rolex can be used as a peer, a comparable for Gucci. Even if Rolex does not produce bags. Am I right? Maybe. Or rings or other things. Only watches. I'm sure that Gucci produces watches, but they are not competitors. But they are in the same industry in the sense that they are in the luxury industry. So comparable first. It means that are not in the same industrial industry. Sorry for the repetition, but identify measures for the comparable firms in the financial statement. So, what are the multiples that we want to calculate? On sales, on the book values, on cash flow, on EBITDA. Okay? So we calculate these ratios, and then we compare the measure to the target firm. A very simple example. Moncler. Now we are looking at Moncler. So we want to calculate, to conduct this multiple analysis for Moncler. We have identified some comparables. Kering, Hermes, Prada, Burberry, Salvatore Ferragamo, Tod's, and Brunello Cucinelli. For each company, we calculate the share price at a specific date, the enterprise value at that date, and the company market capitalization at that date, plus, and then we have some ratios, some accounting numbers like the EBITDA, revenues, net income, and the number of shares. Okay? So we have the enterprise value, we have the net debt, the company market capitalization, and so we have the company market capitalization is the equity value, and the net debt, we have the enterprise value. But how does it work? So we calculate the enterprise value over 3 different accounting numbers: revenue, EBITDA, earnings after taxes. It means that the enterprise value of Kering over the EBITDA, the total revenue, and the earnings after tax. And we have these numbers. So the enterprise value is 5.7 times the revenue, is 17.5 times the EBITDA, and is 36.9 times the earnings after taxes. And this is the set of the comparables. We calculate the average number for revenue. So this is the 4.77 is the average. The average time for EBITDA, and the average for net income. Now we have here the, yes?
when we compute a multiple, we do have to look out for the consistency between the two numbers. How can we make sure that the two numbers that we compute are consistent between each other when computing a multiple? Or
The revenue of Kering, the EBITDA of Kering, the EBITDA of Hermes and Prada?
I mean, in general, when we compute generally a multiple, how can we make sure that the two values that we're going to use for the multiple are consistent and therefore that
What
the
do you mean
multiple,
for consistent?
that they do relate to the same business area and that the multiple makes sense as a performing measure?
This is a good point. We are using so Hermes has different segments, okay? So we consider the company as a whole. So we cannot use we don't have the result for each segment. Is this what you mean?
More or less, but yes. It was a bit different, my question, but still.
Okay.
Because basically I followed a lesson in which it was taught that when computing a multiple and using the trading multiples method, we have to make sure that the two numbers that we're going to use are consistent, otherwise the multiple doesn't make sense.
But consistent within the company or between the companies?
Are consistent between each other, so that there are some multiples which make sense and other ones which are not recommended when evaluating a company.
Okay. So we use the enterprise over revenue instead of enterprise of earnings.
Yeah, in which cases?
Okay. So for example, if we have negative value of the earnings, we cannot use it. Is this the question?
Yeah, more or less.
It is not clear to me what you mean for consistent.
Consistent.
Could you make an example?
I wouldn't be able to because that was the question. So I just heard this lesson and it was told that there are some multiples which are recommended and which make sense, for example, when evaluating the
Okay, so we can use, for example, if there are companies with a very low EBITDA, because their profitability is volatile, we cannot use these earnings enterprise value over EBITDA, because if the EBITDA changes significantly, is volatile, also the enterprise value over EBITDA is significantly volatile. If there are companies with a negative earnings, we cannot calculate the multiple when we have negative earnings. Okay? If this is the question, means the question refers to the fact that some multiples are more consistent, I would say robust instead of consistent, because we can rely more on them. So for example, if in 5 days, 7 peers, we have 3 peers with a negative earnings, we cannot use that ratio. And we cannot calculate the average using that ratio, because the enterprise value cannot be negative. Okay? So, if the question is, if there are some multiples that are more robust in the sense that we can rely more on this, I get the point.
Okay.
Okay? If you mean consistency, and this is the way I understand consistency, means that are these ratios consistent? It means, is the EBITDA calculated in the same way? Because, for example, some companies can calculate the EBITDA putting some items above and the same items is below. So the EBITDA is not consistent because it is calculated in a different way across the different companies. This is what I understand for consistency.
Yeah, it was more the first answer. It was more suitable.
Okay. In that case, I would, and the literature calls this as robustness. Robustness and consistency. So we have this is the average. You could use the average, or if there is an outlier, you could use the median, etc., etc. And this is the accounting number for Moncler. So this is the multiple. This is the revenue of Moncler. This is the EBITDA of Moncler. This is the net income of Moncler. So we apply the enterprise value over revenue over the revenue number, and so we have the estimated enterprise value of Moncler using the multiple. So using the revenue over using the revenue multiple, we have a Moncler valuation of 7.7 billion. Using the EBITDA multiple, we have a valuation of Moncler of 10.8 billion. And using the net income multiple, we have 19.7 billion. So this is the first point. We have a huge difference in evaluation. 7.7 billion up to 19.7 billion, using two different multiples. What is the correct one? This is my first question.
None of them.
None of them. And so it means that we cannot use it. If we, so in this case, we calculate the average, so 12.8 billion. We divide by the number of shares, which is a lot of shares. 258,100 something. And we have the share price based on the comparables that is 49.5 euro per share. The share price actual is 38, and the share price maximum of the year was 51. So using the comparables, we have an expected share price of 45 euro. At the moment, in this day, the share price is 38. It means that the company is undervalued. So if I base my analysis on this, my recommendation is buy. Because the target price is 49.5 and the share price is 38. Okay? Okay? There are some conceptual drawbacks here. First of all, we use the multiple analysis because we don't believe that the share price, 38, represents the enterprise value of the company. Okay? We think that the intrinsic value of the company, so the enterprise value of the company, is not represented by the share price. In fact, we have seen that if we use this estimation, we have that the share price should be 10 euro higher than the actual share price. So we are assuming that the share price is not a good estimate of the intrinsic value. But we use the share price of the other companies to estimate the intrinsic value of Moncler. So we are assuming that the share price of other companies are a good estimate of the enterprise value of the other companies. Okay? And we are not assuming that the share price of Moncler is a good estimate of the intrinsic value of Moncler. And this is a logic problem. Because we say, we believe in the ability to represent the share price, the enterprise value for other companies, to question our share price. This is one point. The second point is we have a huge difference between 7.7 to 19.7. We have made the average. Is it clear that this is very easy? If you go to a financial data set, I'm quite sure that you can calculate this in 1 hour, 90 minutes, and you can evaluate if the company is overpriced or underpriced in 90 minutes. It's very quick, but there are some limits. So the first is what I call the conceptual. Yeah.
For the first point, aren't we just saying that that company is underpriced or overpriced in respect to the others? Not that that is the intrinsic value, but that is the value compared to the others.
Yes, but you can say that the company is overvalued or undervalued with respect to the others. I would say yes, but which one you use? Okay, so we say that the company is overvalued with respect to the others because, for example, Kering has an higher multiple. So Moncler has a multiple about 6, right, for the revenue. So you can, I agree with you. If we calculate the multiple of Moncler, so we start from the market capitalization of Moncler, and we calculate the multiple. So we compare the multiple of Moncler with the multiple of other companies. So this is the answer of your question. The multiple of Moncler in relation to the multiple of other companies. And in that case, we compare the multiples. And we say that Moncler is overvalued or undervalued comparing the multiples. We calculate, here we are doing another approach. The point is, what is the enterprise value? So we forget the enterprise value of Moncler. We don't consider this one. This is what we want to estimate. And we use the multiples to estimate this one. When the answer to your question is we compare the multiples of Moncler with the other companies. So we have this conceptual problem, and then we have some execution issues. And the execution issues refer to the consistency and robustness. Finding the comparable, and this is another example of consistency. Are the peers exactly the peer of the company? So is it correct to use Tod's as a peer for Moncler, or Kering as a peer of Moncler, or Gucci as a peer of Moncler? Is it possible or not? And this is a consistency issue. Different accounting methods for comparable firms. Okay? For example, if we compare net income, okay? And a company has a lot of brands in the financial statements, in the balance sheet, and these brands are amortized. So we have the amortization in our income statement. It means that the net income is lower. If the company does not have this brand in the balance sheet, because they are internally generated, we don't have the amortization, but we still have the asset, even if it is not represented. And all other things equal, it means that the net income differs only for the way in which these assets are amortized. Or we have the goodwill and we amortize the goodwill, or we do the impairment test of the goodwill. In one case we have the amortization, in the other case we don't have any impairment. In different accounting method, there is a different representation of the numbers. And if there is a different representation of the numbers, it might have effect on the multiples. And the other point is the negative denominator. What is the meaning if we have a negative EBITDA or a negative net income? So we have some execution issues. We usually adopt this multiple analysis as a method to check the result of a fundamental analysis. And we use the multiple analysis, especially when we have to evaluate companies that are not traded, to approximate the price, the share price of a company. So they are used in the initial public offerings, in the IPO. And these are simple approaches. Both the asset-based and the multiple analysis are simple, but I have shown some critical issues that are important, and they can limit the usefulness of these approaches. Then we move to the fundamental analysis. The fundamental analysis is an analysis to provide insights about the firm's financial performance. The aim, as I told you at the beginning of this class, is to estimate strengths and weaknesses. Our point is that all the decisions that the management of a company takes has an effect, every decision has an effect on the financial statement. In terms of revenues, in terms of cost, in terms of cash flows, etc., etc. Every decision. Yep.
You said that it has an effect on what? Sorry.
Every decision of the management has an effect on the accounting numbers. In terms of revenues, in terms of costs, in terms of cash flows. I decided to open a new store in London. This has an effect on the revenues, on the cost, on the cash flow, on the market perception of the brand from the customers. I sign a contract with a partner. All these decisions, every decision has an effect on the financial statement, more or less, sooner or later. It might affect now or in 1-2 years. So this is the point that makes the financial statements the core of the fundamental analysis. And we approach to the study of the financial statements according to different perspectives. We study the profitability of the company the ability of the company to generate profit, and I would remind you that we do not look only at the bottom line of the income statement, or usually the financial analysts do not look at the bottom line of the financial statements, of the income statement. So profitability and financial soundness. The profitability is related mainly on the relationship between revenues and costs. And the financial soundness refers to the financial structure of a company. Relationship between equity and debt. The ability of the company to repay the debts. So according to a static representation, so relationship between equity and debt, and a dynamic representation, the ability of a company to repay the debt. The financial soundness refers to the financial risks, the bankruptcy risk. What is important, and I want to anticipate this because it is especially explained in the advanced financial analysis course. What is important is it is not the amount of the debts that we have. We can have debts that are 10 times our equity. But it is the ability of the company to repay the debts. So if the company is able to generate cash enough to repay the debts, the financial risk is low. Because we look at the financial soundness not only according to a static perspective, debt equity, but to a dynamic perspective, the ability of the company to repay. There is a key concept. Okay, I will refer several times during the next classes regarding this. Also because this change of paradigm has introduced new ratios that we adopt to analyze the financial debt. So our financial analysis is a way to estimate, evaluate the financial performance, not only now, but also related to the future. And this is why we do not look at the bottom line of the income statement. And we are interested in other intermediate results. Because our point is to evaluate if this performance is sustainable through time. We make a profit this year, but are we able to make this profit also the next year or not? How sustainable through time is this profit? If we look at the bottom line, these results might be misleading. We need some intermediate results to evaluate if this profit is sustainable through time. And this is the way to predict future performance. The fundamental analysis is not only based on the study of the financial statements. of all, we have to look at the strategy analysis. That it is a core element. So understand the industry, understand the market positioning of the company, understand the way through which the company creates value. Only study the industry, only studying the competitive strategy analysis, we are able to evaluate if the company has a sustainable competitive advantage. So it means that, first of all, when you make a fundamental analysis, we should understand the business of the company, what the company does, in which industry the company works, what are the main competitors, what are the strengths and the weaknesses in the strategy of the company, and then, once we have understood these frames, we can analyze the financial statements. So this is there are several models, you know, the SWOT model, you know, the Porter model. There are several models that are available to study the industry and competitive position of a company. But what is important is that you have to analyze the profitability of the company in relation with the profitability of the industry, right? I know that, I imagine that all of you knows the return on investment ratio, right? So if the return on investment is 7%, I can be very happy if the average in the industry is 3%, or very sad if the average of the industry is 15%. But inside the industry, we can have different segments. And I compare my result with the result of my group of competitors. Okay? And it means that to study industry profitability, we have to focus on different elements of the degree of actual and potential competition, and the bargaining power in input and output markets. It means that, first of all, we have to understand the framework in which the company operates. Without this, we cannot assess the performance of the company. So, industry analysis, corporate strategy analysis, what are the determinants of the competitive advantage? The question is, why are we profitable? Or why are we not profitable? Because of the industry, because of our idiosyncratic characteristics, etc. Why? Because at the end of the day, you have to answer to some questions that explains the profitability of the company. Our low profitability is a matter of the industry. So if we are not happy of this 4% profitability, we have to change the industry. We have to change the market. We have to refocus the company. We have to change the segment in which the company operates inside the industry. Okay? Because the top performance of this subsegment of the industry are companies that has a 7% of profitability, calculated in different ways. Okay, so more than 7% is impossible in this segment. If we want a 10% profitability, we have to change the segment, we have to change the business, we have to change something. It is not an issue of cost or differentiation. So these are the steps. Identify the business model, so what the company does. Then, the competitive advantage. Industry analysis and corporate strategy analysis. The tenets of the competitive advantage. Business model, competitive advantage, and then we go to the financial statement. Because if we had that background, we can explain the dynamic of the revenues during the last 3 years, the dynamic of the cost during the last 3 years, the investment decision of the company during the last 3 years. Otherwise, we are just looking at numbers without explaining the link between numbers and the economics of the company. I don't want that you just describe the numbers. You have to understand, using the numbers, the company. There is a big difference. There is a real big difference. A journalist describes the numbers. A financial analyst uses the numbers to understand the company. We are in the second group. If you look at some newspapers articles, also in the financial journals like the New Sole 24 Ore, the Financial Times, sometimes you find the description of a company in which there is the revenues are during the last 5 years was from $500 million to 1.2 billion. There is an increase of 120%, and they describe this is a description. A financial analyst writes, there is an increase of 120% because, this is the key word, because. Explain why. Because of the industry grows of 150%, but our revenues increased by 120%. We are performing better. Because our growth rate is lower than the growth rate of the industry. This is an explanation. This is still a description, but from the description you will start the explanation. Okay? This is the key point. Try to explain, not to describe. And to explain, we do not focus on the financial statements only. We have to understand the industry, we have to understand the corporate, the strategy. Otherwise, we simply describe the numbers. So that's all for today. For the next class. Next week, we have 2 classes. On Monday, we start with the reformulation of the balance sheet, using a different approach, what is called managerial balance. And on Tuesday, we apply the reformulation of the balance sheet to the FILA case. Okay? There is a section 0 in the slides. And I ask you to go through this section because it is a recap section regarding what is the balance sheet, what is the income statement, and what is the cash flow statement. using the reference to the international accounting standards. So international accounting standard number 1 for the balance sheet, the income statement, and international accounting standard number 7 for the cash flow statement.
We're going to use the 10K method of accounting.
What?
The 10K method.
No, it is not important. Okay, because we are not looking at the bookkeeping, we are just looking at the representation of the financial statements. Okay, so we are no bookkeeping in this course. Okay, no bookkeeping in this course. Probably I might refer to some bookkeeping in some specific cases, but not bookkeeping. Okay, so you are happy, no bookkeeping?
Yes, yes.
So no bookkeeping in this course. We start, no, the bookkeeping is important, the accounting method is important because knowing the accounting method, we know the genesis of the number. But we are not bookkeepers. Okay? And so, so our question is, do we know our accounting numbers to be presented? So the structure of the balance sheet, the structure of the income statement, the structure of the cash flow statement. Because what we see next week is that the numbers presented according to the international accounting standard are not informative for us. So we have to reformulate the balance sheet, we have to reformulate the income statement. So not bookkeeping, just the structure of the balance sheet and structure of the income statement. So you go through the slides, you have the 4 videos, the slide, the 4 videos, and in the additional readings, you have also the international accounting standard number 1 and number 7. And there is also the from theory to practice number 1. There are some very, very light exercises just to refresh some accounting concepts. Okay? So for the next time, look at the 4 videos, go through the slides. If you need, look at the international accounting standard number 1 and number 7. And from theory to practice, there is the from theory to practice number 1 that there are some exercises. There is written also in the detailed program in the last column on the right. Okay? See you next Monday at 4 p.m.